So look, my name is Sean and I've been trading for the last 5 years and I've been able to make over $2 million in trading using only one strategy, which is momentum swing trading. I dropped out of college at 18 years old. I moved out of my parents' house at 19. I moved to downtown Miami all by myself at 20 years old. I bought my dream car. I bought my dream apartment. I basically have everything that I wished for, and I've traveled 20 different countries, all because I learned how to trade the right way. But it wasn't always like this. When I first started trading, I lost thousands of dollars. I followed random YouTube videos, random gurus, joined random communities, and I was trying to find something that actually worked. And I kept losing money month over month, and I actually started to question, does trading work? It literally took me years of losses and years of failures until I finally figured out what actually works. And that's exactly why I decided to do this 7-part swing trading series. Over these coming 7 episodes, I'm going to teach you everything that I learned over the 7 years of my trading from the ground up. Now, let me briefly go over exactly what I'm going to cover over the next 7 episodes so you know what to expect. We'll be kicking it off with this video, which is talking all about the foundation of the markets. I'm going to talk about how to actually read the markets, why there's no holy grail strategy, and the one thing that matters the most that no other trader really tells you, and that's risk to reward. Episode 2 is going to explain price action. We're going to dive deep into candlesticks, chart patterns, what a chart actually is, and how to read it to gain an edge in the market. Episode 3 is going to go over market structure and trends in the market, how to be able to spot trends, how to figure out if something is reversing or if it's pulling back, and how to be able to capitalize on the fact there's a trend in the market. Episode 4 is all about volume, and honestly, most traders use volume wrong. In this episode, I'm going to show you exactly how to use volume to tell the truth of what is happening in the markets, avoid failed breakouts, avoid failed moves, and actually confirm the story behind the price action. Episode 5 is going to be the entry Bible, everything I've learned over the last 7 years on exactly when to enter stocks to have the best risk to reward, and also to be able to manage your risk very well. Episode 6 is probably one of my favorite ones. It's how to find the right stocks to trade, because at the end of the day, you can do everything else right, but the stock that you're trading has to be moving or else you're not going to make any money. And this is probably one of the most important concepts that most traders miss out on. And to wrap it all up, in episode 7, I'm going to talk about discipline and psychology and how to actually make and have a winning mindset in trading. Because controlling your emotions is the #1 thing that will either lead you to success or make you completely a miserable trader. This is the episode that's going to tie everything together, and it's probably going to be the last YouTube trading video that you'll ever have to watch. By the end of the series, you're going to have the complete swing trading momentum system that's made me over $2 million. And also, you're going to know exactly when to enter trades. You're going to have the confidence to do so. You're going to know how to read trends in the market, and you're going to be able to tie that all together into one system that's going to make you money for the rest of your life. Whether you're a complete beginner who's never placed a trade before, an intermediate trader who's trying to find consistency, or an advanced trader who's trying to refine his approach, this series will help you. What I recommend is that you watch this series in order, because every single episode builds upon the last one, and that way you have a perfect blueprint to be able to put this strategy together. All right, so without further ado, let's get into episode 1. So today we're going to be going over how to understand the financial markets. Now, bear with me if you don't understand some of these terms that we're going to talk about. I promise you everything that we get to into the series is going to tie in together. But first of all, I want to explain to you guys how to understand the financial markets, because a lot of people don't understand the actual point of the markets, right? So the point of the market is to allocate capital. What this means is basically, if you have money saved up or if you have capital to use, allocate it to investments that will make you a better rate of return. Now, the goal of the market is not always to outperform and beat the markets. Your goal as a trader, if you are a trader, if you classify yourself as a trader, is not to beat the markets every single day. People have the common misconception that you have to beat the market every single day. You actually have to outperform the market maybe 1 or 2, 3 periods of the year to actually beat the markets by a pretty wide margin. Most people want to make 1,000, 2,000% a year in the markets, but honestly, if you can make over 30, 40%, you're beating the markets pretty exceptionally by about 2 to 3x every single year. And that compounds to an absolutely insane number if you could do that every single year. The next point of the market that you want to understand is asymmetrical risk. You want to be taking asymmetrical risk on every single trade that you are taking. So what I mean by that is a lot of people have the common misconception that base hits in the market add up. You can make maybe, let's say, base hit here, base hit here, base hit here. Now, the issue with this point of view is that it doesn't take into account risk to reward. Professional traders, they're not talking about being right. They're not talking about their win rate, and they're not talking about finding 1 or 2 base hits every single day. What they're talking about and what they're aiming for is actually asymmetrical risk, meaning they can risk a small amount of money or even a big amount of money with small risk to make an absolute fortune. This is called asymmetrical risk. You are risking small to potentially win big. Now, not every single trade is going to hit. Of course, not every single trade is going to be the outcome of asymmetrical risk, but what you should be looking to do is search for asymmetrical risk. And as we get through the series, you're going to understand exactly why this is something that I do. And last but not least, one of the most important points of the market is participation, not prediction. Every single new trader tries to predict the market. They want to be right all the time. The point is not to predict where the market is going to go, because the truth is the market doesn't care about your predictions. It'll go wherever it wants to go, regardless of what you think the market is going to do. Too many traders get caught up in thinking they have to be right on every single trade, on every single idea. If you have an idea, you can't change your thesis. That means you're a bad trader. Well, actually, a good trader will learn how to change their thesis very quickly and be proven wrong by the market. For example, there has been some trades that I've been in where I was leaning to an upside move, but then the market proved me wrong. It reversed, got under the moving averages, and invalidated my long thesis. So I had to switch to the other side to A, make back the money on the trade that I took before, and B, to be on the right side of the market, which is the most important part. So if you don't have a actively unbiased mindset, it's going to end up happening is you're going to get too tied up into the positions that you're looking at, and you're not going to be able to think clearly and think objectively. Always be objective. Do not predict. Use objectivity to look at what the market is doing and react based off what the market is putting in front of you. And this brings me into the next point. You do not need a 100% win rate, and actually the best traders lose over 50% of their trades. It's okay to have a low win rate because win rate does not matter. Again, remember, hedge funds, right? Institutions, analysts, people that actually work in the markets professionally, nobody talks about win rate because win rate does not matter. The only thing that matters is your risk to reward, right? If you can accumulate a lot of risk to reward, a lot of RR on a trade or over the month, you are going to make money. Does not matter what your win percentage was. And I want to break this down because a lot of you might not understand. You might have a 50% win rate, meaning that you win 50% of your trades, and you think that you'll be break even, right? Because every single trade you win, well, the next trade you lose the same amount of money. But actually, the thing is, that's where risk to reward comes into play. So some people might have a 50% win rate or even a 60% win rate, but they'll be unprofitable because of the fact that the risk reward doesn't make sense. Their winners are much smaller than their losers. So they win, maybe they make $1,000, but their losers are $2,000. So now a 50% win rate means you're actually losing money over time. So you can actually kind of use a strategy, or exactly what I personally do, that rewards you for having a good risk to reward and basically makes it so that you have to have good risk to reward, because that is where the money is made in stocks. And this is where we come down to our asymmetry. You need to have bigger wins than losses. If you can have bigger wins than losses, what's going to end up happening is you don't have to have that super high win rate. You could lose 30% of the time and still make an absolute killing, because we are looking for asymmetrical risk and we have asymmetry, bigger wins than losses. And that brings us to the next point. The goal is positive expectancy over time. It's not to beat the markets every single day. It's to give us enough time for a strategy to work, because we know the strategy we're using works over time. All we have to do is be consistent to using that strategy, be patient enough to wait for the right setups, be patient and disciplined enough to wait for the times where our conditions in the market environment line up for our edge. And of course, you want to be focusing on improvement and not perfection, because at the end of the day, no trader is perfect. And even the best traders in the world, they get better every single day and they learn more and more and more, because the market is ever changing. Something that worked 10 years ago might not work as effectively now. The market is always changing. You always want to be able to adapt to what the market is throwing at you and learn from the market. I'm always a student of the market. No matter what happens, I never tell myself I know everything, because the truth is nobody does, and you're always learning more from the markets. Now, this brings me into one of the most important parts about this series. I want every single person to understand, before we even get into the series, that there is no strategy that is a holy grail. If someone tells you that a strategy is one of the best strategies ever, it never loses, they're completely lying lying and trying to sell you a fallacy. If that was the truth, nobody would share their strategy, because at the end of the day, nobody would want their edge to erode. The edge is environmental. This is what people don't understand. You can have the best strategy in the world, everyone can make money on the run up, but then people lose money. And that is where the edge dissipates, because they don't understand, and traders do not understand the conditions that they need to trade in. This is why you want to make sure you're using something called progressive exposure. Whenever your positions are working well and you're making progress on your portfolio, you want to be sizing in bigger, you want to take more positions. Whenever you start to notice that the market is rolling over, your positions are rolling over, every single new trade that you take gets stopped out, you lower your sizing and you manage your drawdown. There's periods within the market while you're going to make a ton of money, and periods in the market where you're going to make almost no money or lose money. And that's okay. We have to understand that it is not a race against every single day in the market. We're not trying to beat the market every single day. Edge is environmental. The ideal conditions for strategies are high volatility, tight ranges and expansion of those ranges, trending momentum, and mean reversion. This is pretty much the only 4 ways to make money in the market. So range expansion, so out of ranges comes momentum. Mean reversions, this happens when there's a lot of volatility. These are the things that you want to see in order for your edge to align. Now keep in mind, there are a lot of traders that do very good during high volatility phases, but will do terrible during tight ranges or momentum move. You have to figure out exactly what works for you as a trader. For me personally, mean reversions and trading momentum is pretty much my bread and butter. One of the most important skills is recognizing active edge. If you're able to sit out of the market whenever your edge isn't present, and you're able to really press the gas when your edge is there, you're going to make a ton of money and keep that money when the market kind of pulls in the other way. Now, trading outside of your edge is expensive noise. What that means is a lot of people will have a strategy and it'll stop working during a specific period, but they'll try to find any strategy that might work during that period. Now, the thing is, sometimes it's okay to admit that market is not working for your edge. And that is a part of recognizing active edge. We don't want to be looking at too many different things. We don't want to kind of style drift and pick up on too many different strategies to implement, because what ends up happening is anything we do outside of our super high probability kind of environments is going to end up in a low probability environment where you're going to do more work. So there's going to be more output for less reward, which is a lost opportunity cost. The goal is to keep your capital for when the market becomes trendy again and makes big moves, so that you can use whatever it is that your edge is. But obviously I'm going to teach you exactly what I do, and you're going to be able to implement that to make a ton of money and then protect your capital when the market is moving the other way. You need to be thinking in probabilities. So it's a series of calculated bets. System wins with bigger, more frequent winners. Obviously, the bigger your winners, the better. Expectation of some failed bets, because you have to think about it. Not every single trade is going to work out, but you want to focus on overall success, not individual trades. And this is something that's super important. Every single time I focus on individual trades, I actually do worse. And that might sound completely backwards, but when you focus on an individual trade, you're not focusing on the system and the process. You're focusing on the result of one trade. You have to be focusing on the process, on the system, on the longer time frames, thinking about a year, 2 years, 5 years down the line, and understanding that over time your system is going to be winning, and not every single trade is going to give you the outcome that you desire. Now, once we start to understand the financial markets and everything that ties into the markets and how we have to view them, we can have a deeper understanding of everything that we do within our technical analysis. Because at the end of the day, like I mentioned at the beginning of the video, not every single thing in the market is technical analysis. A lot of it comes down to psychology and understanding the markets. But once we understand these core principles, now you can actually get an idea of what you need to look for in terms of your technical analysis, the setups, and everything that we're going to cover in the next few episodes. All right, so hopefully this got you guys set up and ready to get into episode 2, which is going to be understanding how to actually read charts the right way, not the wrong way, not predicting, looking to see what the market is doing and reacting based on the market movements, and finding those high probability asymmetrical risk levels that we can use to profit in the markets. I hope you're hyped for episode 2. It's going to be absolutely amazing, and we're going to get really into the nuance of trading and my system. Let's absolutely crush it.